Hello, today we're going to talk about what's going on in the market space, and certainly we're seeing first half reviews coming in, first half of 2023, and it was a sublime first half for stocks, but still we have very good results coming from several names. One of them, Tesla, and Tesla produced 479,700 vehicles and delivered 466,000 vehicles during the second quarter. The delivery figures are an 83% year over year increase that beat, of course, Wall Street's expectations as Elon Musk's vehicle company doesn't report sales figures. Delivery numbers offer investors an idea of how many cars the company has been selling. We're also seeing that there is some movement around China. US Treasury Secretary Janet Yellen will be traveling to Beijing this week to meet with senior Chinese officials, but the Biden administration doesn't expect any significant breakthroughs during the trip. And separately, the People's Bank of China appointed Pan Gongxing ahead of the country's foreign exchange regulator. And as its new party secretary, a role that typically has the most sway in China's institutions. The stock market's astounding rebound in the first half of the year was mostly driven by the seven big tech stocks. Collectively, they accounted for 80% of the gains in the S&P 500, according to analysts, but they are also optimistic that the rally could broaden in the third quarter, especially since a recession may be further off than everyone had expected. This is the major question that we will be seeing coming to the market space repeatedly and also impacting the volatility and the course of the markets. If we look at the bottom line, we see that the NASDAQ composite surged 31.7% since the start of 2023 for the first half. To be sure, part of this is because of the base effect. The Nasdaq was 33.1% down last year. Compared with that dismal showing, any gain would appear monumental. That's what we have right now. Yet, let's not discount the Nasdaq's incredible rally this year has in some ways been a steeper hill to climb for stocks than the last one, because of course you have the central banks still increasing rates, and this is not the best environment for tech stocks and growth stocks especially. We're seeing that inflation has been edging down, but still there is no footprint in the central bank's policy to be seen in the short course. But interest rates are the highest they've been in 16 years and have shot up to those levels in mere 10 months. Those rates have already broken three regional banks back in March and one in May. Nonetheless, technology stocks, typically the most sensitive to the cost of borrowing, are still going strong. If we look at Apple's market capitalization, it's above $3 trillion, making the first publicly traded company ever to do so. That resilience of stock surely is something that many will celebrate, but if we look at the good news in total, it doesn't just stop there. There's inflation expectations for a year from now that have dropped to 3.3%, the lowest level since March 2021. Meanwhile, consumer confidence increased more than expected, according to the University of Michigan Sentiment Survey. Much depends, of course, on June's job report that is going to be out this Friday. If it shows the labor market loosening just enough to not add to inflationary pressures, but still tight enough that unemployment won't drastically increase, then we'll have a good start to the second half of the year. And we still have to figure out what kind of job numbers will come up and be prepared for Friday because that's when they will be published. And for the time being, if you would like to receive any updates on the markets and what's going on in the market space, please like and subscribe. Thank you.